Gautam Chacharya from UBS as well joins in. Gautam, hi. Lots to watch out for this month, both globally as well as domestically. Do you think the market will continue to be range bound?
Yeah, I think that has been our view for a while, and that remains so, at least for the rest of the year and maybe even early next year. So I think from both global macro perspective and local perspective, there are clear some positives, some negatives, but no clear direction, either for a global recovery to be very strong and unidirectional, or locally these early green shoots being strong enough to pull the economy back up on a growth trajectory. So keeping those things in mind and keeping especially where markets are right now, we still stick to our range-bound market stance.
Of late though, Gautam, we've seen that, not just us, but the other emerging markets as well have been shrugging off all the news flow from the US. Do you think this is a trend which will continue and only last up until earnings really start trickling in for us?
That could be the reality check, yes. But yeah, markets have run up, including emerging markets, also in the backdrop of the weak performance prior to that in July and August post tapering concerns. So it's more markets going back to where they were pre-tapering concerns took hold. So again, it's not really a rally or a strong recovery as such. It's just going back, or you could call it mean revision, so to say.
Gautam, markets are certainly pricing in some degree of optimism because of a good monsoon. But your house view is that monsoons are unlikely to boost GDP significantly, and you still remain bearish on two-wheelers. Why do you have such a differentiated view?
Sorry, I won't put it to that extreme on both the GDP impact as well as two-wheelers. So what we are seeing is the impact of monsoon obviously will be positive. It will have a positive impact on the rural economy. But the extent of exuberance which I see among some investors, that seems to be misplaced in our view. Again, if you look at monsoons in terms of spatial distribution, in terms of quantum, sowing trends, etc. So clearly this is a standout monsoon year in recent history compared to all earlier good periods in the last decade or so. But in this phase, we're also seeing economic growth slowing down. And when you talk about rural economy, it's not just agri, it's all non-agri. And that part also depends a lot on how the government is spending. And we're still seeing government fiscal, we heard the finance minister drawing a red line on 4.8% fiscal deficit. And that does impact the rural economy also. So that is a drag. And that drag is very different from earlier periods of strong monsoons we have seen. So yes, optimism, we would agree, but exuberance, definitely not. So that is to put in context there. So, and again, given that in mind, the overall impact on overall GDP growth rate, not just rural part, will be far less muted. So the circular impact of strong agri production and that feeding in to broader economic activity, that will be dampened to some extent by the broader slowdown and government's fiscal stance. So that is one on the macro part. Second is on the two-wheelers part. So two-wheelers obviously will benefit from the rural recovery, specifically the rural part of their sales. So for example, Hero, more than half is rural India. So that part of the sales will benefit. But two things to keep in mind. One is the non-rural part, say the urban part, which will be a drag given the slow macro environment in urban India even now. That will be a drag. Secondly, what we are saying in two-wheelers is that given Bajaj's market share has come off below 20% levels and has been coming off sharply in the recent past, that kind of builds up a scenario of a likely price-based competition ahead in the next 2 to 4 quarters. And again, from a numbers point of view, if we see a strong rural growth point of view, that can delay it. But the market positioning structure right now indicates a likelihood of a price-based competition, which is never good for these stocks. Again, this may not lead to massive price cuts or these companies going in for price cuts to make losses or anything. But purely from where markets are expecting, the margins expectations are there for these two companies, that could see some disappointment ahead.
What have you made, Gautam, of the kind of weakness that we've seen in some of the FMCG/consumption names last week, the likes of Unilever and ITC? So clearly some selling coming in the blue chip names. Do you think the tilt is not really favoring these two names at least?
So that's largely profit taking in our view, and you have to be more stock specific. But yeah, generally from our perspective, we still remain underweight consumption from a macro perspective. Again, within that, some rural focused names will do well, like Dabur, Imami, etc. And even ITC should do reasonably well from earnings point of view, because even the, ITC has more than 40% of its business coming from rural India. But on a broader basis, the consumption trends are still negative, and rural can provide only a boost to small part, ultimately a small part for most of these companies, and does not take care or compensate for the weakening in the broader macro environment. So we still remain underweight, but yeah, in our view, ITC still remains a top pick for us from a macro perspective.
Just want to get back to the point that you were making about autos. So what is it that you like or dislike from that sector?
So two names we like. One is Tata Motors. It's one of our top picks from a broad macro strategy point of view also. And it's not just about currency, etc. or JLR, but also in terms of expectations which are there in the stock right now. Unlike a year back, expectations are much more reasonable, and I would even say conservative. And even the big worry which we had 6 months back when we had a sell about the local CV cycle, that also largely played out in terms of the actual numbers as well in terms of expectations. And that's remains one of our top picks in both auto space as well as top down. The second name which we like in the auto space is Maruti. Again, the weak macro environment is there, but in our view that's largely in the price as well as in terms of earnings estimates. So from here on, unless we see a major crash in the economic cycle, that name should do well from these levels.
Well, work hard. It was down on Wednesday, it was down on Thursday, it was locked down on Friday, but today Wockhardt is almost circuit up. It's a very, very, very volatile stock. Moves just from circuit to circuit. Either Wockhardt moves to the upper circuit or it comes down to the lower circuit. As of now, it appears that Wockhardt is on its way to move to the upper circuit. The top traded counter on both the exchanges happens to be Bombay Dyeing. Of course, there is a buzz that P investors would kick in. Bombay Dyeing is not only a textile company, they also own a lot of real estate in Mumbai. Large part of the land parcel is in and around Lower Parel, which is a very pricey real estate. 61.5 for Bombay Dyeing, up 14%. Gautam, so at the current juncture, what is your take on mid-cap? Are you advising your clients that it's time to take a deep dive into mid-cap because valuations are attractive? The mid-cap index in dollar terms in the last 5 years has taken a knock of 60%.
Yeah, so if you take a 3-year view, 5-year view, possibly yes. But from a next 6 month, 1 year perspective, not really. And that has been the stance for a while for us now. And valuations have appeared attractive for almost last 1.5 to 2 years, and it keeps getting even more attractive as we speak. And the reason for that is technically a lot of these mid caps are owned more by local institutions and also by local retail, and less so by foreigners. And if you've seen last couple of years, both the retail and local institutions have been selling. So the technical support has clearly been lacking for mid-caps. And also among the foreigners, the kind of money flows which we have seen is more benchmark money and ETF money rather than bottom-up India-specific funds, which again typically have a lot more of these mid-caps. So technical support is still lacking because all these parameters are unlikely to change in the next 6 months to 12 months. But from a business fundamental point of view, yes, some of these mid-caps can do well over next 2-3 years. So yes, if you're taking a longer term view and you are willing to take the pain in the near term, then these stocks will be attractive.
Couple of the tire stocks as well have been fairly active, Gautam. Anything that you like out of that space?
Not really. So we only have coverage on Apollo Tyres, and we have a sell rating on that because the current proposed deal will make the risk reward unattractive in our view.
The deal falls through, would you be a buyer in Apollo Tyres? Because even the Cooper Tire shareholders in principle have approved the deal. There's a problem with the Chinese labor union.
Yes, so the deal for falling through is a risk to our sell rating clearly, because the basic thesis behind our sell rating is that this deal makes the risk reward in terms of leverage and the business cycle unattractive. So yes, that will be a positive for the stock.
Axis Bank. Check that one out. Axis Bank has suddenly fallen off the cliff, and it has fallen on very strong volumes. 1.8 million shares only on Bombay Stock Exchange, which means there is definitely some degree of institutional selling which is there for Axis Bank. L&T Finance and Holdings is trending up very nicely on again strong volumes. These are not small stocks, volumes are not strong. There is definitely a favor of institutional buying and selling both for Axis Bank and for L&T Housing Finance. FAG bearing up 41 rupees, liquid stock there. Bajaj Finserv 622, and Tech Mahindra has added another 22 rupees. Gautam, what is the deal with Tech Mahindra? That seems to be the consensus favorite with fund managers and brokerages. Everyone is of the view that this is the next TCS in making.
Yeah, so all the hopes are quite high, clearly, and they have to deliver for. But the good thing about the stock is that at least valuation side, you still have enough buffer for you to make a more positive case.
So, for someone who has the option to only buy one IT stock, and the options are, let's say, TCS, which is trading at about 20 times 1 year forward, or Tech Mahindra, which is trading at 11, 12 times 1 year forward, which is a better bet? TCS, which is predictable, or Tech Mahindra, which is a great story, but they still need to deliver to get that confidence level back?
So it depends on the risk reward of the particular investor, but in our view, TCS is the top pick for us in the IT services space, apart from Infosys.
And what about the mid-cap IT universe?
So we don't have much coverage out there, so I can't comment on individual names. But yes, on a broader basis, the valuations gap is definitely attractive. And we're talking about broad IT services sector. The sector as a whole should benefit from both recovery, currency, etc. So even that the mid-cap space will be a beneficiary of this broader sector positive theme.
Gautam, at a time when banks are contracting their balance sheet, NBFCs are expanding their balance sheet. Are you bullish on NBFCs with that logic that they could really buck the slowdown and they could grow at the cost of the banking sector? Names like Mahindra Finance, Bajaj Finance, or for that matter, Shriram Transport?
So we don't have coverage of Bajaj and Mahindra, but yeah, broader NBFC, we do like LIC Housing or more on the mortgage finance side. But the rest obviously will face pressure points if the economy continues to slow. So top down, not really a space where one would be excited to be invested in from the next 6 months to 12 months. Yes, but having said that, some of them can be a good trade purely from a lower interest rate environment, which some investors hope for. So which we are not really calling out for, at least not for the next couple of quarters.